Hello everyone, welcome back to Mindful Finance, where we simplify finance for you. Today we are diving into a powerful investment strategy known as value investing. Have you ever found a great deal on something you love and thought, wow, this is so much cheaper than it's worth? That's exactly what value investors do with stocks. They look for companies that are undervalued by the market but have strong fundamentals. Anything triggering you, anything intriguing you? Yeah, let's get into that. And this is Sundar, and you are watching Mindful Finance. Now, let's dive deeper into why value investing is more than just picking cheap stocks. It's about making smart choices and steering clear of common traps that can trip up investors. Let's unpack this one by one. First, herd mentality. So, this happens when investors follow the crowd without doing their own analysis. It's like going to a restaurant just because it's full, not because it serves good food. In the market, just because everyone is buying or selling a stock doesn't mean it's the right decision for you. Often, the crowd can be wrong, and following them might lead you to overvalued stocks or missing out on undervalued gems. The next one is the tendency to gamble. Some investors treat the stock market like a casino, hoping to make quick money. They bet on stocks with the hope of sudden windfalls. However, true investing is not about luck, it's about informed decision making. It involves studying financial statements, understanding market conditions, and patiently waiting for the right opportunity. So, this approach reduces risk and increases the likelihood of consistent returns. Lastly, not embracing the uncertainty. The stock market is inherently uncertain. Prices fluctuate due to various factors like economic change, political events, or even market sentiment. Rather than fearing this uncertainty, successful value investors embrace it. They prepare for different outcomes and make decisions with incomplete information by assessing the risk and building strategies to mitigate them. By understanding and managing this risk, you can make more informed decisions and set yourself up for success in investing. Let's take a closer look at how our views, the market views, and the actual company performance interact in this matrix to influence our investment outcome. First scenario. So you see this matrix. So I have put this U is all of us, market, company, and your P&L. So this is a column. So we'll look into different scenarios, what as an investors or what we do in a reality, or what is our behavior patterns, and how market reacts and company reacts, due to which what could be our P&L. So let's get into that. The first scenario, both your view and the market views are positive, and the company also performs well. In this ideal scenario, since both you and market agree that the company has a good potential and it indeed performs well, the stock price is likely to rise significantly. This alignment leads to a huge gain because the positive performance confirms the expectations, attracting more investors and boosting the stock price further. But the way it moves, it might not be what we expected. In the second scenario, you think the company will do well, but market doesn't agree. The company also performs poorly. So this is the riskier situation. Here, your positive view clashes with a negative market sentiment. If you decide to invest based on your analysis, but the company doesn't perform as you expected, the stock price will likely fall. So this leads to losses because not only was the market sentiment already low, but the poor performance also fails to attract new investors, further driving down the stock price. Now, explore further. What if the market is pessimistic, but you see potential that others don't, and the company performs well? So, this scenario can lead to a substantial gains if you invest based on your positive analysis. The company outperforms the low expectations. The stock price may increase as the market adjusts its perception based on the new positive performance data. Lastly, consider when both you and the market have a negative view. So lastly, consider when both you and the market have a negative view, but the company performs unexpectedly well. Even though the initial sentiment is poor, the surprising good performance might gradually turn the market sentiment positive, potentially leading to moderate gains as more investors start recognizing the company's value. So this matrix helps us visualize these various outcomes. By comparing our personal analysis with market trends and actual company performance, we can better understand potential gains or losses. It's a tool that aids in making more informed and strategic investment decisions. Let's see some practical example. Imagine Bandhan Bank. If you have analyzed and believe it's undervalued but the market disagrees, your investment decisions will rely heavily on Bandhan Bank's actual performance. Using our metrics, you can map our potential outcome and decide whether the risk is worth it. This is just an example. Don't take this as an investment advice, but just to explore this matrix, let's take this as an example. Okay, look at this Bandhan Bank. Okay, when it started, let's take this particular time. Okay, market was at this level. This is making like almost like double top. Okay, now people, what you think people might be expecting? Let's think. Put yourself in this stage. Okay, let be in this stage. What is your perception now? How will you decide this one, whether this is overvalued or what is the sentiment of this one? Let's see screener. Okay, let's get into the screener now. In screener, what you can see, go to the similar, like this is a bank, so let's go to price to book. This was during the month of October, when it was 29th of October. Okay, 29th of October. Let's see, 2019, 29th of October. Okay, approximately here. If you see the book value, it is 6.3 and it is like increasing. It is increasing. Now, what will you decide? 6.3. Okay, let's see the performance of the bank during 2019. See, almost 2019 till March. If you see, the revenue has increased. Okay, revenue has increased very nice. It has performed very nicely. See the profit and everything. It's all good. Details are very good, right? If you see the balance sheet, everything is good. Everything is good. But one thing is, our PB is 6.3. It is high, right? So this is how you have to think. Now, after this, what happened now? If you are feeling, by seeing the sheet and everything, balance sheet, everything, you felt it is a positive stock, right? Now, market is not taking that as serious now. What is happening here? If you see after this, it is going down. But if you see the performance during this time from 2019 onwards, look at the thing, 3,000, it is increasing, right? Constantly increasing. Revenue is increasing. But market is not respecting that one. It is going down. So now you see it is keep on constantly going down. Let's look at this area. Now what is this particular time? This is August 2020. Okay, August 2020. Let's see what happened. What is the status? 2020. 19. Okay, March. See, it is increasing. Revenue is still good. Let's see what is the PB at that point of time. 2020. It is book value is 2. It is a very good opportunity, right? Performance is good. Now it's as an investor, this is your guidelines, right? You have to follow this one. Now what happens next? Let's see. After this, PB has reduced. It's very low PB. What is happening? This market is reacting to this. So now you feel it is good. Company is doing good, but market was not thinking it's good, right? So let's see what is happening here. Let me increase the speed. So if you are a proper investor, you will go with the SIP mode. You might be like adding a little, right? That is what you will do here. So till then, it is keep going down. See, market is not responding. You feel it is good. Company performance is good, but market sentiment is not good. This is the scenario. So this is the scenario now. And it is keep going down and down. Okay. So now the sentiment of people, see my sentiment as a investor, based on my analysis, it is a good price. Okay. But others, how will feel, I don't know. But normally people will not feel good about this one. The normal retailers feel this is going down and down. The performance is bad, something is wrong, so people will normally they avoid this company. And again, right now the management is also doing bad, some changes in the not bad CEO changes happening. So till then don't know what happens, so people doesn't know about what is going to happen. So the sentiment wise this is low, so it is not going up. So just note down this one and keep a watch. Let's see what happens. Okay, to sum it up, value investing is about thorough analysis and strategic decision making. It's not just about finding cheap stocks, it's about finding good companies at a great price and managing potential risk. Remember, independent thinking and patience are your best tools as an investor. Thank you for watching it. If you found this helpful, please like, share and subscribe for more insights. And don't forget to comment below with your thoughts or questions about value investing. Until next, keep investing wisely. Thank you.